Welcome to Pete's Property Podcast, brought to you by Buyers and hosted by Pete Wargent, buyer's agent, finance and real estate expert, and all-round property guru, plus published author. Join Pete for 30 minutes as he chats all things property with a new guest each week. Learn practical tips from the movers and shakers in the property industry and well-known personalities sharing their property journeys.
G'day, welcome to this week's episode of the Pete Wargent Property Pod. I'm totally excited this week to have Ben Kingsley on the show, founder and MD of Empower Wealth, and of course the co-host of Australia's most successful property finance and money management podcast with, I always lose track of this, but 16 million downloads, The Property Couch. Ben, welcome. It's great to have you on.
Pete, love being here, mate. Thanks very much for the opportunity.
Yeah, well, as we were just chatting before we came on, I actually came on the Property Couch 2 or 3 years ago, and every time I check up on it, it seems to have another million downloads. So it's going pretty well for you guys. For those who aren't familiar, if you've never heard the Property Couch, Ben is the founding director of Empower Wealth, also the chair of the not-for-profit Property Investors Council of Australia, also very well qualified in the space, a qualified property investment advisor, and real estate licenses across 5 states in Australia, and also qualified with a diploma in finance and mortgage broking management. And of course, one of the leading commentators in the property investing, lending and money management space. Ben, is that a fair coverage there? I could probably talk
I think we've done enough. I think we can move on and talk about the topics of the day. But yes, obviously, when you talk about the business, it's a large advisory firm, so we have multiple facets in that. But I'm sure we'll talk more about that.
Yes, actually, we'll cover that actually as we go through. So tell us a bit before we kick on to talk about Empower and what you're doing there. Tell us a bit about your background. Are you a Victorian originally, and whereabouts did you grow up?
Yeah, so I grew up in a suburb in the northern suburbs of Melbourne on the city fringes, called Bundoora, or as I like to refer to it as Fundura. Yeah, so I had a sort of middle class upbringing, opportunity to travel to the Murray River on many occasions. My folks have a holiday home up there, and just grew up going to public school and doing all the things that you do when you grow up in a great country like Australia.
Sounds pretty idyllic. So how did you go from that background? What actually drew you into finance? Because I'm thinking back through my journey, it was kind of like towards the end of uni, and I was thinking, oh shit, I've got to do something with this degree, and then kind of ended up like a lot of people with an accounting qualification. But how did you actually land on a career in finance?
Yeah, it's funny. I mean, so I studied obviously the classics, the commerce. I did the accounting, economics, maths, sort of background through HSC, and then where my pivot came was my dad worked for Ansett for many years. For those of you who were born recently, Ansett was a previous airline. And so I grew up sort of around the tourism industry and the airline industry. So at the time, I looked at what I wanted to do, and I was looking at tourism as potentially a career opportunity, and there were some new courses coming out. There wasn't any degree in tourism at the time, so I settled for an associate diploma of business in travel and tourism, and so that mysteriously led me to finding a great job at Hamilton Island Resort. So I had the best job in the world for many years on Hamilton, and also being based out of Sydney. So my job was to basically wine and dine travel agents and build the holiday packages that people holidayed on. And I was ended up sort of moving through from a conference organizer on Island to then doing that work as a sales rep, and then becoming the national sales and marketing manager of Hamilton Island, which was, as I said, it's a dream job. When you're young and you're being able to fly up to the island every second weekend and spending time on the Great Barrier Reef and taking people to our signature restaurants. It was just an absolute, ball of a time. And I really loved that time. And then moved across to a company called Voyages Hotels and Resorts, and was the national sales and marketing manager for Ayers Rock, Kings Canyon, Alice Springs, Cape Tribulation, Wildman Wilderness Lodge, so different resorts around Australia. So I very much fell into experiential tourism for our big integrated resorts across the country, and that was, again, a wonderful sort of 12 years coming out of uni or TAFE at the time. Pivoted that story was I didn't really want to go and work in hotels. So that sort of then said, well, what do I do? So I applied for a job in Dubai in one of the biggest integrated resorts over there. And I actually missed out on that job, got down to the final two. But because most of the events occurred through German and businesses coming out of Europe, I didn't have German as a second language. So I missed that job. And then I needed to really think about what I was going to do. Now, I'd always taken an interest in personal wealth creation. That was something that I always wanted to do. My family didn't go without, but money was always debated heavily in our household. And I thought, I never really want to be in a household where I have to worry too much about my financial position. So that sort of led me to, investing in shares in my young years, and then sort of being an amateur and novice, and then starting to go to all of the different events and reading all the books and doing all the, that piece. And so with that as a backdrop, I then decided, all right, well, maybe my future is in, sort of becoming a broker and then working through and doing financial services to help other people invest in property and those type of things. So that is the origin story in terms of being able to play that out. And I was really passionate about helping other people. You sort of do that in sort of taking travel agents and teaching them how to sell your pay 5, stay 7, or kids eat, stay, play and eat for free, or your, Red Centre Explorer type holidays. It's always education, and then basically helping people to experience those things. So that's the origin story to sort of get us to where we are today, which was I started to really understand property. A critical part of that is the finance piece, and so that led me into that area. And again, going to all of those seminars and reading all the books, and so much different information out there, Pete, in terms of what can be done, what can't be done, and conflicting information, and what's the best strategy, and all those types of things. So when I started Empower Wealth, it was a story of about how do I consolidate that and try to bring that into one umbrella operation to allow for the consistency of service and helping those people.
Fantastic. Well, you've done especially well to come back into the real world after working at Ayers Rock Resort and Hammy Island and
yes.
All of those other places. So, I mean, today we know Empower is a huge brand, and I think 120 odd staff across the business units. But tell us a bit about the journey and how you grew the brand, because obviously these days with the podcast and kind of a leading real estate and financial services brand. But how did you actually go about growing the business?
Yeah, I think the origin story is always then around the purpose. So there's obviously a great book called Good to Great by Jim Collins, and that framed up the story about basically what I wanted to do and what I was passionate about. So it's pretty easy to go to work when you're passionate about helping others. And so the vision and the ability to build the business was always around doing the fundamentals well, which was understanding the problems you're trying to solve for the client, and then potentially showing them that opportunity in terms of how that came together. So in the earlier stages, podcasts, pre-YouTube, pre-internet, right? We did a lot of research, fundamental research that we were doing in terms of magazines, books, getting that sort of data. These days, we can collate all that data a lot more effectively and richly together. But that was, the journey. This vision of a single home where you could get holistic advice from individual specialists. So you weren't going to get a jack of all trades. You were going to basically build a team of people around you who really knew their craft and had the experience to bring the people together to solve for the problem and hopefully plan out that future.
Yeah, and as mentioned, the podcast going from strength to strength over the years, and the numbers. A great example of how to snowball or compound your results. The numbers almost exponential over the years. And now, Ben, I guess what people always want us to talk about is the state of the market, what's going to happen next, and all the rest of it. Now, I do know as the chair of PICA, the Property Investors Council, you take a lot of interest in things like tax and lending policy, and I guess all policies that impact property investors. But before we come on to some of those issues, let's just talk about what's going on in the market. The day we're recording, we just had the latest wages growth figures out, and they were pretty underwhelming. Certainly no price sort of wage price spiral that people have been fearful of. So what do you think about all the latest market dynamics? It seems to me that over the past month or two, some of the extreme doom and gloom in the media is tapering off a bit. So do you see this as kind of just another cycle, or is there likely to be a deeper downturn as interest rates go up?
Like you, I do love the numbers in terms of trying to understand the trends and patterns in there. And again, like yourself, I've been fortunate enough to go through multiple cycles over my own personal investment journey, which started way back, when I was 23 to buy my first property and sort of building out that wealth story now. And I'm, sort of just coming up to 51. You can learn about mindset and confidence and looking at that, but you can also learn a lot about those data trends. So, take, for example, the wage index. It's like that is challenging to me, right? In terms of, because I'm looking at some other data that's also showing, which the RBA is also, alluding to, and that is that anyone who's changing jobs is getting significant uplift in their particular salaries at this moment in time because there's competition in the market. But obviously, 40% of the workforce are on contracts, minimum wages and those types of things. So, or work for government and that's the challenge we have in terms of that's not showing up in the data and that's not moving through. So there is definitely people who are enjoying some higher wage rises, but it's not right through the whole system. And I think that's why that's anemic in terms of that wage growth story. But from an inflationary control point of view, it's actually a good news story. We don't want wages to get too far ahead of themselves, because what we don't want to do is build an expectation that wage story, that everyone's going to get 5 or 6% wage growth each year, because ultimately that then bakes in that higher level of inflation. And that's not good for sustainable long periods of growth phases inside each cycle. So I'm a big believer in that 2 to 3% inflation level as being able to then allow for extended growth periods inside an economy. And I do believe that if we can, obviously get the inflation genie back in the bottle without going over the level that we need to go to in terms of interest rates. So we talk about neutral interest rates being between, say, 2.25 and maybe 2.75 would be a neutral setting, neither expansionary or contractionary. If we sort of have to land there, I think we'll have to overshoot that in this particular phase and sort of head up towards that 2.75, maybe 3. But I'm hoping that the RBA sort of looks and says, well, let's have a pause and let's see what's basically happening. Because I think when we do get that pause, what's going to happen is that sentiment will start to bottom out and start to turn. And I think that will be the smallest shot in the arm that we need. Make no mistake, our cost of living is still going to be higher. Our repayments are going to be higher for those people that have mortgages. But I'd like to think that would land the plane without really any risk of going into recessionary territory. And I think that would mean that, where the bottom for property prices are and what sort of percentage of correction we get might land between that 10 and 15%. But if we have to go over and above to get inflation under control, we could see, higher deterioration in short-term values. But then I expect that to sort of bounce back relatively quickly when, rates are adjusted back down to those more neutral levels in, say, 23, 24. And I think people will look back and say, all right, well, that was a 12 to 18-month period that we just needed to keep an eye on. And here we are again in terms of with a fairly good economic story here in Australia, positive migration. And I think people would then say, I wish I had bought in 2022 to early 2023 instead of waiting, because now the market's moved and they've missed out.
It's been a totally unusual couple of years, and I guess as a result, a really odd cycle. So I guess, look, reading between the lines there, I'm hearing you think that a recovery in the housing market probably won't happen until either the Reserve Bank stops hiking, or at least people get a sense that there's a pause coming. So maybe a taper in the pace of tightening. Because I guess the fundamentals, in many respects, immigration's coming back and unemployment's the lowest level in half a century. But I guess people are just, you'd think, sitting on the sidelines, just waiting to see what happens with rates. Is that roughly how you're reading it?
Yeah, I think what surprised me, Pete, in the last couple of uplifts in the property cycle is how quickly it turned. One of the things we see, and you and I, you're a student obviously of the share market as well. In the share market, your sort of depth of market of your buyers and sellers you really need, quite a lot of depth in market to sort of move prices over the longer term. In property, you can have, an area where people are looking and over a course of 2 or 3 weekends, you start to see the other people who are also checking out the same properties that you are, and then you see them putting their hands in their pocket and everyone's a little bit concerned. But it only takes that sort of 2 to 3 weekends before the market starts moving. So I use the example of, let's say there's 6 couples, the investors, mixed blend of first home buyers, investors, upsizers, downside, and they're all going around and market sentiment's a little concerned. So everyone's keeping their hands in their pocket come auction time. But then all of a sudden, 2 of them start to compete on one property because now, whether that's because the cash rate has now slowed to, rather than 50% increases, down to 25. So I'm just feeling a little bit more comfortable. I'm feeling a little bit more understanding of the changing environment that I'm in. And so those 2 people compete out, and then the rest of us miss out. And then the next week, another couple of the people that I've been seeing, from time to time competing against me at these auctions, they're now in the second phase of that next week. And they're also now thinking, well, I don't want to miss out. And that's how quickly the property market can turn. You don't need depth of market to balance the market out. Obviously, the deeper the market, the more bidders you have, the deeper pockets they have. That's when you get those strong, solid runs that we saw recently, in this particular uplift cycle. So for me, that's like, it's all guesswork. You're trying to make a prediction of a base case. My base case, that is, if, sort of the cash rate gets to around 2.75, then I would potentially like to think that by the middle of next year, we're at the bottom and potentially starting to look at some price growth. If we get to a 3 to 3.25, we've probably got a little bit more of sort of downward pressure, and we probably will start to see the second half of next year where we see property prices move a little bit higher. But astute buyers at this time know that that's the best time to buy when others are fearful. So, the marketplace will be the marketplace. There will be those people who can't move past that mindset, or who think they're going to pick the bottom when ultimately they won't, because the bottom will be gone. Coming back to that example that I used before, it was those first people that probably battled it out on that first weekend. And interestingly enough, Pete, what we have seen in some of the auction clearance rates, even though we've seen withdrawals, there is a little bit of a sign there, and I'm interested to see how next weekend goes, because we've seen 2 weekends in a row where we've probably found a bit of the bottom, and we're sort of ticking up a little bit. So that is also obviously a leading indicator that we keep an eye on to sort of see exactly where the sentiment is sitting as part of our predictive work that we try and do.
Do you want to save on buyer's agent fees? You could save thousands with Buyers Buyers. As Australia's most extensive network of buyer's agents, we can lock in highly competitive prices. Plus, our national network of buyer's agents are some of the best in the business. So get the Buyers Buyers advantage and talk to us today. Call 1-800-975-051 or visit buyersbuyers.com.au.
I think, as you said, the last couple of cycles, there's been this kind of big pent-up demand as various issues have disrupted the market. But then there's suddenly sort of whipsaws when things recover. As you said, it can turn on a dime sometimes. Famously, the 2019 election being one of those cases. And you mentioned getting inflation under control, and wanted to talk to you about a couple of recent policy changes. Obviously, a big part of the inflation story is things like rents. There's other stuff going on in terms of household power bills and energy prices, but there is really a rental crisis in some parts of the country. I saw yesterday Sydney's asking rents are up 20% from a year ago. Sunshine Coast has been worse. It's been probably a 30% increase. Very little rental stock. But there's quite a few policies that have really just sort of made life, if anything, harder for landlords, or trickier to actually add to the rental stock. So there's 3 things in particular I wanted to talk about. Firstly, the lending buffers that are in place through the regulator APRA. Then we've had some changes to tenancy laws. And then in Queensland, where I'm based, changes to land tax. So why don't we tackle those in order? Now, you're an expert or a specialist in lending and broking and what goes on in that space. So just harking back to last year, I think APRA introduced in October effectively a 3% assessment buffer when a new borrower went to take out a loan. So I guess in plain English, a stress test to see whether the borrower could repay in the event of a 3% increase in interest rates, which kind of, I think, made sense at the time because there was a lot of, like a borrowing binge, and also interest rates were clearly going to go up. I guess the thing is now, probably by September, we'll have already seen probably 2.25% increase in the cash rate, or 225 basis points. So the bulk of the tightening is already done. And also there isn't a borrowing binge happening. So I've seen you state elsewhere that you think we should go back to sort of a 2% floor, such as we had pre-pandemic, and the cash rate was at a similar level today. But what do you see actually happening at the coalface, and what are your thoughts on it?
Yeah, I mean, this is a big story, right, Pete? Because what we don't want to see is we don't want to see people trapped in a mortgage jail. And by that, what we're saying is because we've had such a rapid uplift in regards to interest rates, those interest rates then impact the assessment rate or the borrowing power of a borrower. And so what I've been sort of publicly putting out there is that, yes, pre-pandemic, we had some certain rules. So I'll give you a quick backstory on APRA for those of you who haven't been familiar. Back in December of 2014, APRA introduced a 10% speed limit basically on loans to property investors. Now, then in 2017, they also put a limit in terms of how quickly you could grow your mortgage book and interest-only loans as well. So you couldn't have more than 30% of new business on interest-only loans. So this is coming back to your bigger point, Pete, around the impact on rental, right? And how we're here where we are. Now, if anyone looks at the rental activity, the investment lending activity between 2017 to pretty much the end of 2000, it fell off a cliff. So those instruments that both the APRA and the Council of Financial Regulators introduced did their job. They certainly took the heat out of the property market, and we were publicly saying that probably there was a bit too much activity from investors in that particular market. And so that played a role. But when you take those investors out of the market, you're also taking the renter out of the market, because if we're not buying those investment properties, those private rental accommodations aren't available. And so that reduces the stockpile of available rentals. Now, fast forward to the conversation we're having. When the pandemic hit, what we did see is in 2019, APRA basically announced to lenders that they have this loan servicing ratio where they had a floor rate of 7% or 2% buffer was what they were working on. Now, in July of 2019, they released a paper to ask the question of whether we want to say, let's move away from the 7% fixed and let's now introduce a 2.5% servicing assessment buffer that you would add to that. So they introduced that. And then October last year, on the 6th of October last year, they then came out and said, we want to increase that to the 3% level. Now, the reason for introducing the 3% level was exactly that. Cash rate was down at 1.1 of 1%. It was a risk. There was potentially systemic risk in the system if people overborrowed, knowing that rates will never be that cheap forever. So that's what's happened. But to your point, Pete, and what you and I have been talking about publicly is that we are now back to a cash rate of 1.85 with a potential another 0.5 increase as early as September. So we're at then 2.35. Well, that should be enough to say we're nowhere near those emergency settings, and it's only prudent for the lender to lenders to be able to lend money appropriately. And we don't want to see, again, borrowers trapped in mortgage jail, because those borrowers could potentially shop their business to a new lender, but not if the servicing at the new lender doesn't allow for that. So they become trapped. And then ultimately they're at the whim of that lender in terms of the interest rate that they charge. If investors could shop around and find a cheaper lender and refinance, and then potentially there's less pressure on putting rents up, because ultimately as investors, we don't want to always put rents up. We're not here to be greedy, empire builders. What we're trying to do, generally speaking, is get a fair return, a risk-adjusted return for our investment. So if we don't have that, pressure coming through, then ultimately we don't need to push rentals higher. But because we're getting slammed, not only by the higher interest rates, and we're going to talk about the changes to the Rental Tenancy Acts and also the land tax in Queensland shortly. But because those things are coming through, we are experiencing, as landlords, additional costs. And so we need to pass those on. So I'm encouraging APRA to make the next prudent call, which is to actually adjust that down. Now, they have to go back down to 2.5 as the first step. But if rates keep going up higher, it only makes sense to me that they adjust back to that 2% assessment buffer, because that would be equivalent to where the cash rate was at the time that they had that 2% setting in play. And that just means that there's a little bit more borrowing power for those people who can afford, but it also means you've got mortgage mobility and you're not trapped in that rental jail.
Well, that makes perfect sense. And as you said, APRA was happy with a 2% floor sort of in the pre-pandemic days. And in fact, the Bank of England recently effectively scrapped the buffer, went down to just 1 percentage point. But yeah, back in those days, nobody was sort of shouting about this being a high-risk policy setting. Historically, mortgage defaults in Australia have been very, very low. In fact, their arrears are at record lows at the moment.
Yes.
I think the other thing is there's a lot of talk about housing affordability, and Labor's got its Help to Buy scheme. But if you've got the lending buffer set at 3%, when you've already gone through most of the hiking cycle, it doesn't make it very easy for the new entrants to get into the market. In fact, in many cases, impossibly difficult. So I guess that's one of the sort of key issues at the moment. You mentioned there the Tenancy Acts as well, and changes to tenancy laws. Now, I've been a renter when I was a student, and I was a renter in the private landlord market when I was working in London. Then I was an owner. Then I've been a rent investor and a landlord. Now I'm an owner again. I guess 95% of the time, the system works pretty well. Not everybody wants to own a property all of the time, me being a good case in point. And I think one of the key things is for an economy to grow and prosper, what you really need, especially at the moment, is a flexible labour force that can find rental properties where they're needed. And yet, at the moment, it seems to me the pendulum is swinging sort of away from private landlords being able to provide property. So explain to us a bit about the recent sort of proposed changes to Tenancy Acts, and what are those impacts likely to be, do you think?
Yeah, there's a lot going on here, Pete. This sort of process has been ongoing and drawn out for a long period of time. And what we always know about any type of government reform, and what we also need to acknowledge, is that some of the reforms that have been introduced, one could agree that it's definitely in the benefit of a better relationship between tenant and landlord. So being able to make sure that you provide safe accommodation is a good example of that. Actively repair sort of damaged goods and so forth in an appropriate manner. So there's no doubt that, like anything, there's extreme cases of greedy landlords and there's extreme cases of tenants acting very badly. But to your point, I saw some recent data, and I'm happy to share that with you. 100,000 claims roughly, or disputes, are settled across all of our councils, in terms of the tribunals, I should say, around Australia. Now, if I use the latest data from ABS that says around 2.84 million properties are for rent, then effectively 96.5% of properties operate smoothly, right? So we're talking about 3.5% of those properties are in dispute in any 1 year. Now, again, this is where we get frustrated, is because the regulation has ultimately poured heavily in favour of the tenant. And with all of these additional regulations and all these different restrictions, two things are happening. Firstly is that, if people want to play on, if they want to bat on as investors and landlords, their costs have gone up. Their compliance costs, their admin costs, their property managers are putting their fees up. Every time in a lot of these reforms, there's extra safety tests that have been done. So if you have a tenancy for 6 months and then you're out of there, the next person that comes in, you've got to drop another $500 on the gas, test and all of that. So naturally, they are costs, right? So the landlord's got to make a decision in terms of how much of those costs that they pass on. And they are doing that right now. They're passing on costs because of higher interest rates. They're passing on costs because of increased compliancy obligations. And they can do that because the market is tight, because the other option is to sell and get out. And so we're seeing evidence of Victoria, especially 133 changes to the Act, a huge reform program going on, and landlords are voting by selling up and getting out. And so that's resulting in less available tenants, less available rental accommodation, and a shortage of tenants. And, we're talking about, this is going to get worse, Pete, because, looking at the June numbers of visas to come in for student visas, we saw a record increase in that intake. So where are they all going to stay? And then we've got migration. Where are they all going to stay? So we are moving towards a very dangerous situation. And we've got some states and territories who are about to make their decisions in terms of how much reform they do. So Victoria, New South Wales, ACT, Tasmania have all made their decision. Queensland have done part one. They're coming back for part two in October. That's absolutely going to increase costs. So that's going to be passed on to tenants as part of that. And WA have got to make their big decision, which we'll hear about soon. And what was interesting with the WA story, if I can take some liberties on that one, the Real Estate Institute of Western Australia actually did an independent research piece on that particular story. And the findings are actually quite shocking in regards to the impact on the rental market in WA, which is already in crisis because of the vacancy rates there. But the economic forecasts were this. Oh, no, I'll start with 60% of those surveys said they were likely or very likely to sell their investment properties in the next 2 years if the proposal to remove the right for a property owner to terminate a tenancy and the proposal to remove the requirements of a tenant to seek consent of the property owner to make modifications to the property. They were the two big issues. 60% would cash out in the next 2 years. Now, the economic consequences of those are tenants across the state would pay an extra $105 million in rents annually. And the other big one there was investors would be slugged an additional $142.5 million in higher property management and holding costs. So here's another example of market interference, not letting the market run efficiently. And so we were talking about a market running relatively efficiently when you got 96.5% of harmony between, tenants and landlords, and huge reform being done for that sort of bottom 5%, let's call it, in terms of changing the market. Well, these are the unintended consequences. You are going to make the tenants pay more because the cost of running, managing, looking after that property and the compliance costs are going up. So it's only fair that some of those costs will get passed on to the tenant. So unfortunately, great intentions from, with this reform, but the consequences of basically making rents a little bit higher.
Absolutely. I think when the system works well, what you want is landlords to supply quality rentals for the long term. So you're giving people security of tenure. We've, in our sort of personal property investing, we've owned property for 26 years. We've never sold one. Just trying to think of an example. After the global financial crisis, we bought a property in the home counties in England after the property crunch. And we've had the same tenants there for 13 years or 14 years now. Polish family came over from Eastern Europe, and they've been the best tenants we have ever had. And the rents are exploding at the moment in the UK for, I guess you've seen what's happening with the inflation numbers over there heading to 13%. But I've got no incentive to increase the rents on them because they've been the best tenants I've ever had. They've been fantastic. They've prospered all that time. And I guess that Australia seems to be going down the route of a disincentive to supply quality rentals and security of tenure for decent periods of time. And anyway, we've covered some of the reasons.
Well, that comes back to your point, doesn't it, Pete, about if you can't provide human capital mobility easily, then the economic consequences are material, right? If you've got projects that you want to start, whether that be infrastructure projects, nation building projects, and you can't house those people effectively or economically. Those projects get delayed, the economic benefit gets delayed, gross domestic production suffers. The whole thing, spirals in on itself. So it's absolutely critical. And as you were saying before, not every tenant is a forced tenant. There's a lot of, I recently rented when we renovated our home for 6 months in one period, and we've rented quite a lot. And like you, when I came out of high school and wanted to experience Melbourne, I rented a property for 12 months. So that was by choice. So I think there's a narrow-minded view that for every rental property that's not available, someone's just bought it and now they're going to live in it. And that's just not necessarily true.
Now, while we're on the subject of flawed policies, I've mentioned, I think, on a podcast somewhere before, where I come from in England, there's actually quite a lot of professional landlords and probably far fewer mum and dad or part-time landlords who just have a random single investment property. And I think part of the reason for that is tax policy. I think in Australia, if you try and grow a property portfolio, now you guys, tax advisors and specialists and people can structure their investments appropriately so they don't get slugged with land tax. Whereas I think one of the things that has stopped professional landlords in Australia and most people only owning one or two investment properties is the disincentive of land tax. Whereas in United Kingdom, you can grow huge portfolios without the same issue. So a recent change, though, Queensland, where I'm based in Australia, recent land tax changes and quite a rapacious move that hopefully won't be replicated across other states and territories. So, Ben, talk to us a bit about what's been proposed in Queensland. What's the potential impact, do you think, on the market?
This is material, Pete. I mean, the other governments and territories around the country are sort of saying, are they trading off, okay, yes, there's higher costs, yes, it's going to be passed on to the tenant, but the greater good is the tenant gets a safer, better accommodation. I mean, that's probably what they're debating in their head. In the Queensland situation, it's an absolute cash grab. It cannot be, sort of mentioned in any other way. So their proposal, which is going to be unique in this country, is that if you own a property in Queensland and you own property or land in any other state or territory in Australia, they are going to use the land value of that other property in the other states or other jurisdictions, and they are going to use that to calculate the amount of land tax that you pay. So that's obviously one part. So land tax, usually there's a threshold, and once you go over that threshold, then the state government start charging you annualised tax for that property. Now, I have no problems with state governments charging a land tax per se. I mean, obviously, I'm getting the benefits of the society and the investment that goes back in that land. But this is extraordinary. This is basically asking people who have properties in other states and territories outside of your principal place of residence, or if it's a primary producing land, so we want to make sure we're clear on that they do the calculation. And on their very own website, the increase is a 332% increase. So their example goes from a Queensland-based investor paying $1,950 in land tax and then buying a property interstate. That property increases their land tax from $1,950 to $8,422. That's a $6,472 increase, hence the 332%, $124 a week. Now, make no mistake, Pete, this is a rent tax. This is going to be a rent tax. If there isn't any other justification for passing on some of these costs to tenants, this is it. So, and what's extraordinary about this one is that the landlord who may have properties in other states and territories are going to have to explain to those tenants in the other states that I'm increasing your rent to pay Queensland's land tax because they've now factored in this property they own interstate. I mean, it is totally extraordinary that this rent tax is going to, because it will be passed on. I mean, especially in a tight rental market, and it's going to have different nuanced consequences for each independent investor. So we've done some models where we might have a client in our business that has 2 investment properties in Queensland and 1 in Victoria. So what do? Do they bat on and, they have a 300% increase in land tax that they have to pay to the Queensland government? They'll probably maximise what they can out of the Queensland properties. So the Queensland tenants will probably pay more rent than the others. But if there's a top-up that they need, they're going to actually ask for those other tenants to pay it in the other states. Now, if you're a tenant sitting in Ballarat and you're getting a letter apologising from your landlord saying, the Queensland government's increased my land tax by $6,000 in a year, and I'm really sorry, but I'm going to have to, just to recover my costs, I'm going to have to charge you an extra $30 a week, and I'm charging my other tenants in Queensland an extra $60 or $70 a week to cover that. It is just extraordinary that they would take such a policy with their budgets and then pass that through the budget to raise an amount of money which is immaterial of about $20 million is what they're claiming. So the brand damage of Queensland, we've got even clients saying, well, that's it, I'm going to boycott Queensland from a tourism point of view. Like if they're going to take $6,000 of the rental income that I'm getting, I'm recovering that from my land, I'm not going to holiday there, because in principle it just doesn't pass the pub test. Why would you tax land outside of your jurisdiction to basically, increase your revenue coffers? It's just a rent tax. And unfortunately, it means that everyone around Australia who's renting could be susceptible based on where their landlords own their property. So it's unprecedented, and it's really an interesting policy. And I think, when clearer minds prevail, I'm hoping that they will effectively withdraw this policy, similar to the way in which the Victorian Labor Party, coming up to an election year, promised a developer tax, only to have the developer industry say, well, we're going to do a marketing campaign that says under Labor, your property is more expensive because of this developer tax. And so Labor saw that as politically untenable, and so they pulled that threat. Well, I think the Queensland Labor government should also be considering just how much value they're going to get out of this in terms of introducing this tax that affects every state and territory in Australia based on the fact that, your landlord might have properties around the country. It's extraordinary.
And we've already got a rental crisis in southeast Queensland, Sunshine Coast. I mentioned the Gold Coast, the same, to some degree Brisbane as well, certainly in some parts of Brisbane. It's interesting, the census always shows that in every other state and territory, the share of rental properties and landlords is broadly the same. Queensland's the only state where there's far more interstate investors, and this could have quite a serious impact on the rental market. I don't know if this is related, but I've just noticed in recent weeks and months, things like units in New Farm and the inner west of Brisbane and some townhouse developments suddenly just catching a bid. And I don't know if that's to do with people shifting towards the medium density sector or not, but certainly definitely one to watch. So Ben, I guess we could talk all day about policy, and you're a man who knows more than anyone else in this space. But let's wrap up. So we're having this conversation in a year's time. Sounds like rents will be higher, and hopefully by then the Reserve Bank will have tapered off a bit, if not potentially looking at easing monetary policy. What else do you see, let's say in a year's time, August 2023, housing market recovering and hopefully the economy on a soft landing?
Yeah, I think that's the crystal ball that I like to look through. I think what's different about this slowdown is the level of household savings that is going to cushion a bit of the blow. And the other critical factor is obviously the unemployment story. So, I don't see systemic risk in the property market because of behavioural economics terminology here, but you've got two things going in. There's a loss aversion. So people dig in harder. So if they're finding it tough to make their mortgage repayments, they've got options to do a repayment holiday or to grab a second job. And there's plenty of second jobs going. So I don't see, all of those, naysayers and doomsday reports out there that are trying to drum up that message that there's going to be a significant property crash happening in Australia. But I do feel like, there will be a breather in the property market, which was relatively needed. It was pretty hot there for a while in 2021. So I just probably think we're getting back to a more normalised market. And if we avoid the recession and interest rates are sitting around that 2 to 2.5%, then people will feel quite comfortable in paying sort of 4%, 5% for their mortgages. And we'll probably get back to a more normal property market where we have a balanced market, maybe moving towards a bit of a market where it might be more of a seller's market than a buyer's market. And with that obviously means property prices starting to move in late 2023 is sort of a baseline guess.
Makes sense. Well, I guess the past couple of years have shown us how difficult it can be to make predictions, and the immigration or arrivals figures basically stopped and now suddenly roaring back. So very difficult to predict in real time. Ben, where can people go if they want to find out more about Empower, or if they want to check out the Property Couch podcast? Where should people go for more?
Yeah, thanks for the opportunity, Pete. Look, from my point of view, I'm an educator at heart. I want people to financially transform. So we've written a couple of books. The first one is Make Money Simple Again. So if you go to, we give that a book away for free now. So makemoneysimpleagain.com.au is a great place to start, or our other best-selling book, which is The Armchair Guide to Property Investing. You can also get a free copy of that by going to thearmchairguide.com.au, or you can check us out at the Property Couch.
Fantastic. And I'll actually, after a bit of time in Europe, I'll actually be down in Melbourne in a couple of weeks. So I'm looking forward to some decent coffee. Good Lord, it's a shock coming over to the other side of the world compared to coffee down your way. So, Ben, thank you so much for coming on. It's really been a privilege to be on this side of the microphone and tap your brains, and look forward to chatting again in due course.
Oh, and thank you, Peter, for having me on. And if I can say, Pete, from my point of view, you're obviously one of the leading thinkers in this space, and anyone who's obviously checking out this content, make sure you continue to keep listening to Pete's views and direction. He's a thought leader in this space, and I really enjoy chewing the fat with you all the time when we catch up, Pete.
Oh, I'll definitely have you on again with that nice little plug. So thanks, Ben, and talk to you again soon. Cheers.
Thanks for listening to Pete's Property Podcast, powered by Buyers. Don't forget to subscribe and join us next time as Pete chats all things property with a new guest. And just a reminder that the information provided in this podcast is general advice only and doesn't take into account your personal financial situation or needs. You should always consult a licensed professional to discuss your individual personal circumstances.